Thanks everyone for joining this virtual meeting of the San Diego chapter of the Association of Corporate Counsel. My name is Colleen Smith. I'm a partner in the San Diego office of Latham Watkins and the chair of the local litigation department practice in San Diego. And we're proud, of course, to be a sponsor of the local San Diego Association of Corporate Counsel chapter. Today, I'm joined by my colleagues, Drew Capurro and Kristen Murphy, and I'll allow them to introduce themselves as well, and then we'll give you a preview in terms of our subject matter for today. So let me turn it over to Drew and Kristen.
Great, thanks, Colleen. Hi, everyone. I'm Drew. I'm a partner in the Orange County office of Latham's Orange County office, focusing on capital markets transactions and representing public company clients. As part of the SPAC boom that has that we've all been witnessing and been a part of for the last 18 months in particular, I've found myself extensively involved in those, not only through the SPAC IPO process, but then also the SPAC process, and then working with public companies post that business combination with the SPACs. Kristen?
And I'm Kristen Murphy in the Orange County office. I'm a counsel here in the securities litigation group. I focus my practice on sort of a combination of transactional litigation, breach of fiduciary duty type disputes, and then also securities, 10b5 cases in federal court. And as Drew said, we've all been very, very busy with all the various SPAC issues in the last 6 months. So we're excited to talk about that today.
Great, good. Okay, so we go to the first slide, and I'll just, or the second slide rather, after our lovely pictures, and I'll set the agenda for everyone. So, here's what we plan to talk about today, but obviously this is a, relatively small group. We want to focus on the issues that are of interest to you. So please interrupt us with questions, or, feel free to pop on your video and ask, you can type in the Q&A, but we're also totally comfortable for you to pop on and just ask us the question, interrupt us as we go, as if we were in person. First, Drew is going to walk us through, from the transactional side, some key issues and trends that he's observing as he's been working on all of these SPAC formation and SPAC transaction matters. And then Kristen and I will frame up the litigation landscape, which has obviously been a hot topic, including a discussion about guidance that has been, statements rather that have been made by the SEC, as well as recent developments in terms of proposed legislation and congressional testimony, actually just last week. So we'll walk you through all of that. And then, as I said, we'll leave some time at the end for questions, but we really do prefer if you interrupt us and ask questions. It's a lot more fun that way. So with that, I will turn over to Drew to start with the transactional side of things.
Thanks, Colleen. So I'm, as I mentioned, as I think all of us mentioned, and as I think everyone on this call is probably aware, there's been an enormous uptick in SPAC activity really in the last 2 years. SPACs aren't new necessarily. They've been around for quite a long time, and even with a lot of the current features, they haven't evolved too much fundamentally. But you can see here that the massive uptick in SPAC IPO activity in the last 2 years. 2020 exceeded the 4 years prior combined, and then through 2021, and really that's the figure we have here is mostly through the first quarter of 2021 already exceeded the gross proceeds raised in SPAC IPOs compared to 2020. It's a little bit of volume. It's also, there's, these SPACs come in a variety of sizes. There will be SPACs that are as big as, that raise as much as, $1.5 billion or something along those lines. And there's also many more that are in the $250 to $300 million range when they're doing their IPO. Colleen mentioned the recent SEC guidance that has caught a lot of attention in this space, not only from SPACs and their sponsors, but also the companies that are either merging with SPACs, maybe considering a merger with a SPAC, or in some instances have already merged with the SPAC. The two statements, the first was by the acting director of Division of Corporate Finance, John Coates, who, among other things, really highlighted the use of projections in de-SPAC mergers, which is one of the key distinguishing features from a traditional IPO context. In a traditional IPO, a company's projections never see the light of day. They'll be shared with the research analysts as part of the process for helping build the valuation, but the public never has access to those. Whereas in the de-SPAC process, that's actually one of the key characteristics of how those transactions were marketed. And then the second of these two statements, and probably the one that's caused more near-term flurry of activity, was the statement from the acting chief accountant on the accounting treatment for the SPAC warrants. Maybe I'll kind of take a step back there. For those that maybe aren't as familiar with the SPAC's capital structure, when they undergo an IPO, they sell units to the public, and those units consist of a share of common stock and then a fraction of a warrant to purchase a share of common stock. When the SPAC engages in a de-SPAC transaction with a target, with an operating company, those public investors, and the stock trades, so it might not be the same IPO investors, but the public investors, they have a chance to not only vote on the transaction, but also have a chance to redeem their shares in connection with the transaction if they don't like the economics of the target, or they don't like where the stock's trading. They have a chance to redeem their shares and in return get their money back plus the nominal interest that their investment has accrued in a trust account since the time of the IPO. In addition to that share of stock, they also get a warrant. The warrants haven't changed meaningfully over the last 7 to 8 years, I would say. The form of warrant agreement that has been used by most SPACs is, before April, was relatively consistent transaction to transaction with some changes on the margin. But the statement on April 12th, through all SPACs and de-SPACed companies at various stages, in a bit of a state of disarray, those warrants had historically been accounted for as equity on the company's balance sheet, first on the SPAC side, and then post de-SPAC transaction, once the operating company inherits those warrants as part of its public company capital structure. But the statement by the acting chief accountant essentially said, we don't agree with that position necessarily, and we think that there's a couple of reasons why. And so it's having devoted, I guess, now 6 weeks to the fallout from this announcement. There's an incredible amount of analysis that's going in at the SPAC stage, at the de-SPAC stage, and then the public company, the post de-SPAC stage, in terms of what the ramifications are for those announcements. It's led to a high number of restatements, also led to a considerable pause in the market for transactions that were in process, not only SPACs that were thinking about an IPO, but then also transactions that were signed up but still in the SEC review process, because they really couldn't proceed from where they were until there was resolution on what the implication of this statement was for the company, and or the SPAC, or the company, and where they were at that point when the statement was made. Go next slide. SPAC frenzy drying up. So this is an indication by deal volume of where the SPAC IPOs, or how many SPAC IPOs we've seen. The April fall off, I think, is in part because of the is in part a result of the announcement from the SEC on the SPAC warrant accounting. I think it would have dipped anyways, so that the announcement was on April 12th, so you can see it wasn't necessarily on the same pace as it was during the first quarter of the year, or maybe even necessarily with the last part of 2020. But compared to the first part of 2020, which was still resulted in a tremendous year-over-year growth in terms of the number of SPACs, that number was not far off. Next slide. And then similarly, I think you can see some of the a little bit of the slowdown in the de-SPAC context. Some of this here is again complicated by the fact that the announcement on the warrant accounting. The other overlay here is these de-SPAC transactions. They're typically, not always, but typically accompanied by a private placement. So sequentially, and this is maybe getting a little bit ahead of ourselves in the presentation, but at a high level, the target company and the SPAC will go and market to institutional investors in a PIPE leading up to the signing of a de-SPAC merger agreement. A couple reasons for that. First of all, we mentioned that the SPAC's public stockholders have a right to redeem. These PIPE shares do not. So it is money that's locked in. It's insured for the target company. Essentially, if the deal closes, if the SPAC deal closes, then the PIPE money will be there. It's also a validation from a marketing perspective of the valuation that the SPAC and the operating company have agreed on. So with that backdrop, it was not only did the warrant accounting point throw some of the market in flux, but also there was some choppiness in the PIPE market that has slowed down a lot of the but not eliminated some of the deal volume that we were experiencing in the first quarter of 2021. You can go next slide. So what is a SPAC? Maybe I should have started with this. It IPOs, in some way, it's an IPO for a big pile of cash. The SPAC goes through an IPO process and files a registration statement like a normal company going through an IPO process would file with the SEC, and it needs to be cleared by the SEC. But it has no operations. It says in its registration statement, we have assembled this group of management members and these board members, and we are going to go look for an attractive target that we think will bring a return to our investors. And the practice of how specific the description of the area or business that that SPAC might pursue, that varies. There's some litigation elements to that Colleen and Kristen will get into, but it's these SPACs, they go public. They have the redeemable stock and the warrants that they offer to the public investors, and they have a limited lifespan to them. 2 years is the standard, and it's almost like a scarlet letter if anymore if your SPAC has been out in the market, meaning post IPO, for more than a year and hasn't signed up a target, especially in this environment. So we see SPACs, going through the IPO process, and then as soon as they are done with that IPO process, but not before, that's when they go in pursuing targets. If they've pursued a target too early, they've entered an LOI with a target, that triggers a number of disclosure implications for their IPO that would slow down the IPO process and really make the whole SPAC process move. Next slide. And so we talk a little bit again of like how this process works from formation to consummation of a merger for the SPAC. So the IPO process can take 8 weeks for, we'll see sponsors who are repeat issuers. They'll be on SPAC 4, 5, 6. Some of them are, kind of celebrity type sponsors. Others are private equity firms that have made carved this out as a real repeat investment strategy for them. The key timeline after that is the search for a target. We mentioned that these SPACs will have a 2-year lifespan before they need to wind down their operations and distribute all of their money that's held in trust back to their public investors. But they're all typically very proactive right after the IPO to try to find that target and begin negotiations. It's very typical for a SPAC to, enter several dozen NDAs and trying to find what they think is the right investment opportunity for themselves, for their stockholder base. And then the actual de-SPAC transaction process. So once there is an LOI signed up between the company and the SPAC, a lot of the timing will depend on what sort of work is necessary in order to bring the SPAC or bring the company to market. So in that respect, there's a couple of considerations. The first is if there's going to be a pipe, what's the sizing of that pipe? When are market conditions right? I'm trying to play that out a little bit. There's been a little bit of a slowdown lately, like we mentioned, and then also having the company ready or as ready as possible to be a public company. We'll get into that shortly, but at the end of the day, from the company's perspective, this is an IPO that's dressed up as a merger, as an M&A deal. So they have to be ready to comply with all the various components of being a public company, but it might be on a bit of a more accelerated time frame. Next slide. SPAC formation. I think we've covered this by and large. We could probably go on to the next one. Top de-SPAC issues. So I think this is as much. This will be a little bit more focused on the target company perspective on things. But again, these transactions are an alternative way to going public and an alternative way really to doing an IPO. So when we're talking with our company clients about what they need to be thinking about in order to engage with one of these transactions, a lot of it is the same as what we would be talking about with a company that would have approached us, 2 or 3 years ago and not even known how to spell SPAC, but would have just been like, okay, we want to go public, let's do an IPO. So in that respect, there's a couple of things. One of the first things that we talk about with a company that wants to go public is your financial statement. Your financial statements are going to look different, and the process for preparing them is going to be far more intensive. And so that's part of any company going public, is having the financial statements audited by an independent audit firm to PCAOB standards, public company standards. That is a meaningful difference from the private company AICPA standards. For some company, and that'll be at least 2 years and maybe 3 years of audited financials. So that can be a really time-consuming, expensive, and burdensome undertaking, especially for a company that hasn't been thinking about going public for a couple of years. Another key part of being public that we talk about early with de-SPACing clients or potential de-SPACing clients, the same that we would an IPO client, is you're going to have to be ready to report as a public company. So after the transaction, you're going to have 10Qs that need to be filed within 40 to 45 days after the quarter's over, and your 10K is going to need to be, and your audit is going to need to be done, in as little as 60 days after the fiscal year end. And that's a real change from operating in a private company environment. That for most of our clients, and this is one that anyone who's going public is going to have to almost inevitably have to increase the resources that they're using on their own internal accounting and finance departments. It's just how quickly are you able to do that, and how quickly are you able to amass the right experience? Because that's, with the number of companies that are going public, there's just a very high demand for people with that skill set, that experience set. Another consideration that we've highlighted here, and I think is worth noting, is the corporate governance and audit committee. Public companies generally, unless they're a controlled company, need to have a majority of directors on their board who are independent, and then they have to establish and maintain an audit committee that consists of at least 3 independent directors, a nominating committee, and a compensation committee. And so, excuse me, in an IPO context, kind of using that, again, that as a benchmark, where we might be in touch with a company client that's looking at this process, and they might come to us in January and say, we think we want to, have an organizational meeting in May or June of this year and be public by September. There isn't, some of these company clients are being approached by a SPAC, and maybe an IPO was wasn't a 2021 thing for them, but it was a 2022 thing. And so they weren't quite as ready and haven't given as much thought to these sorts of points. And again, one of them is having a board that satisfies not only SEC requirements, but also NYSE or NASDAQ requirements. Next slide. And then common mistakes and pressure points. Again, I think kind of touched on some of these over the last couple of slides, but that I think they're worth hitting on again. The first is the rush on the M&A process. This is, I think, a natural result of the limited lifespan that the SPAC has. They're in a crowded environment. So if they're not, they want to get a deal done, and they want to make sure that they've realized the return on their investment that they've made through the SPAC. There is certainly, as regulatory and media attention has increased on the de-SPAC transactions, we're seeing more of a focus on the diligence exercises through the M&A process. I think that trend, it's only going to continue to be more intensive as the market continues to mature on this. In terms of target preparedness for being public, that's it. Again, this is where we might have been dealing with a company that had a very long runway through thinking through an IPO process. Some companies, once they get an opportunity with a sponsor that is showing their investors an attractive valuation and an attractive capital raise, we'll figure it out on the fly. And they're, people are, they're not always, they don't have necessarily the same preparation that a company that has been building out its team and its resources for a longer period of time might have. Next slide. I think it's Colleen and Kristen's turn.
Yeah, thank you, Drew. So I'm going to talk a little bit about, now that you have this very thorough background on all things, SPAC on the corporate side, how that's translated into a lot of risks that we are seeing, and that plaintiffs are now calling out in a number of lawsuits. You saw the chart that Drew showed you about the proliferation of both SPAC IPOs and de-SPACs in 2021. The litigation is following a similar trend. We saw a handful of suits in 2019, a handful in 2020, and within the first few months of 2021 had more than each of those within a few months, and we're seeing more every week. I'll talk a little bit about the different types of lawsuits that we're seeing because they are all different. We have the disclosure litigation bucket, which is sort of just the typical merger strike suits. If any of you have just ever done traditional public company M&A or take privates, you have no doubt seen the same cast of characters, call it 6 to 10 law firms who like to file very similar complaints at almost every law, in almost every public company merger. Is usually just seeking additional disclosures and more recently bringing those claims under Section 14A, given ever since the decision in Delaware to stop approving disclosure-only settlements. We also have breach of fiduciary duty claims that we're seeing. Colleen will talk a little bit about, in particular, the multi-plane case, which is one of the more interesting ones. But what we are seeing in these SPAC transactions or these de-SPAC transactions is that a lot of people are wearing a lot of different hats, and we have a lot of serial SPACs. I don't want to use that pejoratively, but we have a lot of SPACs that do a lot of there are multiple versions of the SPAC, and they do a lot of different de-SPACs, work with a lot of the same banks, have directors who may be directors at a target, and so there just tends to be a lot of overlap. Like I said, a lot of different hat wearing, and that is starting to be challenged on the fiduciary duty side. We are also seeing securities class actions under Section 10B and Section 14A, and a little bit under Section 11 and 12. For those of you less familiar with this type of litigation, obviously Section 10B is a securities fraud claim, meaning there has to be a material misstatement or omission in connection with the purchase or sale of a security. With respect to SPACs, this is something that every public company faces, but what we're starting to see is, post de-SPAC, the public company not doing as well as investors had hoped for a number of reasons, and the plaintiffs bringing Section 10B claims saying that the insiders knew that this company was not all it was cracked up to be, and made misstatements about that in their registration statement and also in their quarterly earnings announcements following the de-SPAC. Section 14 is, just prohibits misstatements and omissions in connection with the solicitation of proxies. So it's a little bit easier of a claim to plead because there's no scienter requirement, meaning it doesn't have to have been done with intent. Just more, if you made a false or misleading statement in connection with asking people to approve a de-SPAC, then you are you are liable under Section 14A. And then of course, Section 11 and 12 is about offerings of security. And we are, I think not seeing, plaintiffs are still trying to figure out exactly, what this looks like and how Section 11 and 12 interplay with the de-SPAC process. So I'll talk a little bit about the disclosure litigation that we are seeing just in terms of the merger strike suits. Just as it has been with public company M&A, we are seeing not quite as many plaintiffs come out in the de-SPACs, but on announcement of these de-SPACs, we see the same 2, 3, 4, maybe 5 plaintiffs. They'll send demand letters. They will send. Some of them are filing complaints. Some of them are Section 14A complaints filed in federal court. Some of them are, quite a few of them are breach of fiduciary duty claims brought in the state court of New York or whatever state court, where the SPAC is headquartered. These claims are typically brought against the SPAC and its board of directors. So typically the target is not the subject of that. That sort of changes when we'll talk about some of the post de-SPAC type suits, breach of fiduciary and 10B cases. But these are strike suits. the SPAC, sort of has the option to issue additional disclosures. I think in a lot of ways, for a lot of reasons, the disclosures that these plaintiffs aren't attending these webinars necessarily, and they haven't quite figured out what SPACs are and what these de-SPAC transactions entail, because a lot of what they ask for makes zero sense in a de-SPAC transaction. They're focused on traditional take privates or M&A, where there's always a fairness opinion. There's a group of shareholders that are getting cashed out and not getting to move on with the public company. So a lot of their claims make no sense. They're already weak claims in the M&A context. They're even weaker in the de-SPAC context. I think because of the post de-SPAC world that we're dealing with, and all the tricky issues that we're seeing, conflicts, breach of fiduciary duties, we are advising clients to provide clear and complete disclosures of all potentially material information. Anything to do with, as I said, sort of directors wearing multiple hats, bankers, what we've seen, bankers acting both on the investment banking side, and they may have a relationship with the target, or they have a director on the SPAC. So all of that is the type of disclosure that we would, those are the kinds of things that can lead to real lawsuits that Colleen is going to talk about.
Great, a perfect segue. Okay, so Kristen mentioned the 3 buckets of litigation, and she's talked a bit about the first bucket, which is the merger strike suit disclosure litigation category. I will talk about the next 2, and these types of cases are, as Kristen alluded to, brought after the de-SPAC. So either involving the SPAC and the SPAC board, or involving the target company after it has become public through the de-SPAC transaction. And these 2, at least for now, these 2 categories of litigation are the more dangerous, potentially expensive kinds of litigation. In terms of the fiduciary duty litigation world, the multi-plan case in the Chancery Court in Delaware is the case that everyone is watching. This case is brought by a fairly competent plaintiff's firm, Bernstein Litowitz. It's a fairly well, structured complaint. And basically the issue that's teed up in this case is whether SPACs whether the de-SPAC process includes a fundamental conflict of interest such that the transaction itself can never be reviewed under the deferential business judgment standard. So just to set the table for those of you who may not be familiar, I believe most of you are, but most corporate decisions that are executed by the board are subject to the business judgment rule. It is very deferential, and courts will defer to the business judgment of corporate directors. When there are conflicts of interest, there are a number of other standards that can be applied. In this case, the argument is because the SPAC sponsor received founder shares, and those founder shares can be extremely valuable, the fact of those shares, as well as in this particular case, which is also true in a number of SPACs, the other directors who sit on the SPAC board also receive founder shares, that in and of itself is sufficient conflict to bring the transaction into the next level of review. And that level of review that's being advocated for here is entire fairness. And that basically means the court will have to determine whether the de-SPAC was entirely fair, whether there was a fair price and it was entered into through a fair process. Ultimately, at the end of the day, the de-SPAC price and process may be deemed fair. The problem is, once you're in entire fairness land, it's almost impossible to win a motion to dismiss. So you are looking at, as if you are defendants or your directors are defendants in this kind of litigation, actual litigation with discovery and potentially depositions and the associated expense. So that's what's going on here. This particular de-SPAC is a little bit interesting. This was a Churchill Capital SPAC. The SPAC sponsor is Michael Klein. Churchill Capital actually, I think, has had 4 or maybe even 5 different SPACs go through de-SPACs at this point. In this case, there was a financial advisor. The financial advisor was somewhat affiliated with Churchill Capital and Michael Klein. So that's little bit unique in that it may be, you know, it may be a way to distinguish other de-SPACs depending on how this case ultimately turns out. But this is one that everyone is watching to see, will the Chancery Court apply the business judgment rule, or will the court conclude that the mere fact of the founder shares in the hands of the founders and the hands of some of the board members on the SPAC create an inherent conflict such that the entire fairness standard potentially would be applied. So that's the key takeaway on this one, and this is definitely one to watch. I'm going to go to the next slide. So then the third bucket of cases that we are seeing are the more traditional private securities class action cases, typically involving Section 10B and 14A of the Securities Exchange Act. These cases are brought against the de-SPACed public company, the company itself and its executives. And we are seeing the SPAC sponsor and the SPAC directors in some of these cases being named as defendants as well. So kind of at this point, the litany of potential defendants. So the SPACs are not off the hook just because the de-SPAC transaction has been completed. The target company is included, but the SPAC sponsor and the SPAC directors have been included in these. These basically look like your standard private securities class action cases. There's, you know, some event that causes the stock price to drop, and you know, the stock price drops, and you're hit with the standard complaint that says basically the fact that was revealed that caused the stock price to drop should have been revealed sooner in connection with the de-SPAC, and because it wasn't revealed at that time, it was a, you know, material omission. That is the standard you know, sort of type of these cases that we're seeing. I will note a lot of these cases are cases in which there's been a short seller report. So this has been a trend just generally in the securities class action world over the last couple of years. There are a number of very active short sellers who issue short seller attacks. Some of your companies that you all have been affiliated with may have had the pleasure of you know, dealing with these types of short seller attacks. And unfortunately, they are everywhere, and they're very self-interested. They are, in fact, you know, affiliated with short positions, and then they issue these very negative reports in an effort to profit. That kind of activity has slowed down a little bit lately in the wake of the GameStop you know, incident, that being very high profile, and retail investors having done their level best to leverage, you know, their position against the shorts. The short sellers have slowed down a little bit, but we are seeing a few of these short seller reports having an impact on post de-SPAC public companies, particularly in high tech, volatile spaces like electric vehicles, tech, you know, some of those industries. So that is a trend that we are watching unfold. There are, as Kristen mentioned, so far this year, there've been about, at the time of the last, you know, cut, there were about 10 cases. I think we're now up to maybe 14 or 15 just in the first part of 2021. Most of those cases are in the very early stages. So, you know, the cases that have been filed the first part of this year, we won't see any action in those until later this year. But the handful of cases filed last year, those are starting to get to a dismissal stage. And I'll just flag a couple of those to watch. The first is the Waiter case, which is pending in the Western District of Louisiana, not the court I would necessarily choose for the first SPAC case to be decided in, but alas, that's where it is. And the thing to watch in that case is the extent to which the court will evaluate or consider the impact of Director Coates' statements about the PSLRA safe harbor. There's another slide on that, so let me just put a pin on that, and I'll explain that a bit more when we get to that slide, which I think might be the next one. But that's definitely the issue to watch in the Waiter case. That is fully briefed. It was argued on May 12th. So we're waiting for a decision in that case, and we'll see how that goes. Two other cases to mention are that you may have heard of, those of you who have been watching sort of the de-SPAC world for a while, are the Nikola and the Clover cases. Nikola is one of the electric vehicle adjacent companies. Clover is a healthcare affiliated company, not strictly a life sciences company, but healthcare area. In both of these cases, the allegations focus on the sufficiency of the due diligence to uncover facts that supposedly existed at the time of the de-SPAC, but were not disclosed in connection with the de-SPAC transaction or in the subsequent, sort of initial subsequent public filings post de-SPAC. It's resulting, as Drew said, these cases have gotten a lot of attention. And as a result, the diligence around de-SPAC transactions has gotten, I would say, even more rigorous over the last, little bit of time, given sort of allegations that were made in these two cases. So these also will be cases to watch. They are having an impact, sort of post de-SPAC on what does the litigation landscape look like, but ex ante, they're having an impact on what does the de-SPAC process actually look like and how much diligence is required. Is it full IPO style diligence? Is it something less than that? These cases are ultimately going to probably have some bearing on that. So I'll just flag those as well. The next slide. Okay, I think the next slide after this is the safe harbor. So very hot topic in the SPAC world is the extent to which the safe harbor applies. And so basic issue is as follows. Claims that are brought under the Securities Exchange Act, and those are typically the Section 10 and Section 14 claims, are eligible for the PSLRA safe harbor protection. And in a nutshell, what that is, and many of you know this, statements that are forward-looking, like financial projections, and accompanied by sufficient cautionary language, risk factor disclosures, are exempt from liability. You should not, in an ideal world, be facing any liability on those kinds of statements for those claims. Now, this protection is not typically available in your S1 in connection with an IPO because those claims are governed by the Securities Act, Sections 11 and 12 of the Securities Act, and specifically exempted by statute from eligibility for safe harbor protection. So you typically do not see financial projections, as Drew said, in your IPO registration statement because in part because you're not entitled to the safe harbor protection. And there is a fairly strict liability regime in place for a traditional IPO registration statement. There's no scienter requirement, and of course now no safe harbor. So the discussion generally has been up until this point, is it safer, if you will, less risky to go public through a de-SPAC because you are not subject to the strict liability standards of the Securities Act, and you can take advantage of the safe harbor, which means you can provide your investors with a bit more information about sort of the prospects of the business going forward. The statement that John Coates made relatively recently, he at least called into question whether or not the safe harbor should apply to a de-SPAC transaction. And most commentators and academics, and certainly, those of us, on the corporate law firm side of things, view that as a statement, a pretty aggressive and maybe creative reading of the statute that the safe harbor might not apply to Section 10 or 14. The statute is, if you look at the statute, quite clear. Safe harbor should apply to any forward-looking statement in connection with a de-SPAC transaction. But there's a lot of discussion around this. And in fact, in the last 2 weeks, the House of Representatives has put forward a piece of legislation that would actually amend the statute to remove safe harbor protection for de-SPAC transactions. Congressional hearing was held on that issue just a few days ago, actually, to discuss both sort of broader potential regulation of SPACs, as well as that particular proposed piece of legislation. So I think we'll have to just watch and see what happens there. Right now, there's a lot of focus on this issue. Whether the legislation actually, goes anywhere or not, we shall see. But it's definitely a hot topic and one that is being heavily watched. And then just circling back to the Waiter case, the Director Coates' statements about the possibility that the PSLRA safe harbor might not apply to a traditional de-SPAC or to a de-SPAC transaction, that issue has been sort of teed up in that case. So that would be, if the court addresses that issue the first time, that question will be put to a court. And so again, we'll see if the court addresses that issue or not in the Waiter case. Footnote here, just so folks are aware, there is another doctrine that applies to forward-looking statements. It's a common law doctrine called the bespeaks caution doctrine. Because it's not statutory, courts do apply the bespeaks caution doctrine to statements that are not subject to the safe harbor. So if you, for example, have participated in a traditional IPO, you will know that there is this doctrine that offers some protection to companies going through a traditional IPO for statements that are more forward-looking in nature. It basically says you have to read the statements in their full and complete context, which means you have to read the risk factor disclosures that accompany those statements. And courts will look at all of that typically under the bespeaks caution doctrine. It's a little less robust than safe harbor, but it is there. So if for whatever reason the safe harbor goes away, there will, these deals will not be totally naked. There will still be some legal protection available to us if we're litigating the cases post SPAC. So that, I'll turn it back over to you, Kristen.
Thanks. So turning back to conflicts of interest, we talked about multi-plan. As Colleen said, this is something it's in the very early stages right now. But if the court accepts plaintiff's theory that the entire fairness standard should apply based on the conflicts there, as many of you are aware, that's a very, very onerous burden for defendants to carry in litigation. And sort of just as a reminder, the entire fairness review standard applies if a plaintiff can demonstrate that a majority of the board is conflicted, or otherwise rebuts the business judgment rule, or the defendant engages in a conflicted controlling stockholder transaction and does not adopt certain procedural protections at the outset, namely, if you are familiar with the MFW case that is in the more traditional take private context, that standard requires, a fully functioning special committee, approval of the majority of the minority, and a number of other full disclosure, and a number of other factors that it has to be conditioned on these things at the outset of negotiations. So that is, I think, which has been defined to basically be the start of economic discussions. Once there are deal prices exchanged, that is the point at which a deal needs to be conditioned on these things in order to move the burden of entire fairness, or basically put the standard of review back to business judgment rule. If entire fairness applies to your transaction, you have to prove, meaning the defendants have to prove that it was a fair price to the stockholders and that it was a fair process by which it happened. Like I said, that's a very heavy burden to carry. In a non-controller transaction, the approval of the transaction by a fully informed, uncoerced majority of disinterested stockholders takes the review standard back to business judgment. That is the Corwin v. KKR case. And that is the reason why we are always, yelling in our corporate guys' ears, their corporate team's ears, that, we want robust disclosure of any potential conflict, because those are the types, conflicts are just such a hot issue. Like, those are the things that will make a court find that it was not a fully informed vote. If there was a fully informed vote and an approval of the majority of disinterested stockholders, they will almost certainly not be able to get past the pleading stage. The business judgment rule will apply, and it's basically impossible for plaintiffs to state a claim after that. So what else can you do to manage your process besides full disclosure, as we say a million times? Consider a special committee comprised solely of disinterested and independent directors. That committee should be able to retain its own independent legal and financial advisors. Consider having that committee receive a fairness opinion. We are seeing this more, it's not common necessarily in the de-SPAC transactions, but we are now starting to see this a little bit more, people getting fairness opinions as a way of trying to shield themselves from these claims, right? To safeguard as much as they can. Allow the committee to serve as the principals negotiating the primary terms of the transaction. Obviously, if you have someone who is wearing multiple hats as a director at both places or whatever, keep them out of the process. Make sure that, documentation of board meeting minutes are clear, that these people are not in the room making these decisions. Very clear corporate record keeping is super important. I think robust minutes are good. We used to try to kind of trend towards very thin minutes that did not tell a robust story. And I think courts are increasingly finding that that is really not sufficient to put on a defense. And that's why in, for example, Section 220 cases, we're seeing production and ordering of production of emails and even text messages, because the real story of a process is not being told in corporate records. As I mentioned, condition the transaction on the approval of the holders of a majority of unaffiliated stock in a non-waivable, fully informed vote. I already talked about recusal. I talked at length about disclosures. So these are just some ways, even if you think it's not a true controller transaction, think about using some of these tools, because we're sort of in a brave new world here, but we think that some of this will go a long way in defending against these cases down the road. So I think that's it.
That's it. Yeah. If anyone has any questions, feel free to jump in or type them in the chat. And then I'll just add, we will, a couple of folks have asked if the deck will be available. My understanding is ACC will make the deck available, and you've got our information here. So I know we don't have that much time for questions, but of course, you've got our info. Feel free to reach out to us on any of this. Happy to be a resource for you.
Yeah, thanks for having us.